They told you sanctions would break Russia. They told you freezing reserves would end the game. They told you the Fed still controls the board. Then a quiet spreadsheet update on a Saturday proved the opposite. On January 18, 2026, a single number appeared on a Russian government site with zero fanfare. Russia's gold reserves were valued at $326.5 billion as of January 1st. That's not a headline. That's a warning flare. Because 12 months earlier, that same line read $195.7 billion. Same vaults, same country, different reality. And here's the part that should make you sit up straight. Russia didn't rack up that gain by panic buying bars. Russia ended the year with less gold, about 6.2 tons less. Less metal, more value. A $130.8 billion jump while reducing tonnage. That is not markets fluctuate. That is gold doing what it always does when trust in paper starts to rot. Tap subscribe so you don't miss the next update, because this story doesn't move in tidy chapters. It moves quietly, and then all at once. Now let's translate what that one number really means. You can freeze bank accounts. You can sanction payment rails. You can block SWIFT. You can seize bonds held in custodial systems you control. But you cannot freeze a metal sitting in a domestic vault behind a sovereign border. That is the entire lesson in one sentence. And Russia just put that lesson on a scoreboard for the whole world to see. Gold, over the last year, was not a commodity. It was a referendum. It repriced upward not because jewelry demand surprised anyone, but because the global system has been leaking credibility. The dollar is still the unit we speak in, but gold is the unit the system obeys. And Russia, sitting on roughly 2,300 plus tons, got paid for holding something no central banker can fabricate. This is where it gets uncomfortable for the people who mocked gold as a relic. A central bank that can print currency can still be powerless against an asset you can't print. No rate hike makes gold appear. No bond auction conjures ounces. No press conference restores trust once trust starts leaving. And Russia isn't doing this alone. That $326.5 billion is the visible tip of a larger shift spreading across the non-Western world. China, India, the Gulf, new BRICS entrants. Countries that watched one event in 2022 and never forgot it. Because the freeze of roughly $300 billion in Russian foreign exchange reserves didn't just punish Russia. It rewired every finance minister who lives outside Washington's comfort zone. If it can happen to a nuclear power with a commodity base, it can happen to anyone. So the question isn't, did Russia's gold go up? The question is, how many countries just decided they can't afford to keep their lifeboat in someone else's harbor? Now let's back up and map how this was built. People love to treat this like a one-year anomaly. It's not. It's a long pivot that the West mostly laughed at while it printed. When the world is stable, you optimize for yield. When the world is unstable, you optimize for control. 2008 was the proof that the reserve currency will be expanded when stress hits. QE wasn't just policy, it was a precedent. If the system breaks, new money appears on command. And if it can appear on command, it is not scarce. So Russia changed its reserve posture the way serious actors always do it, not with speeches, with behavior, quarter after quarter. Then 2022 arrived and turned theory into law. When Western authorities froze a massive chunk of Russia's foreign currency reserves, they proved a brutal fact. Reserves are only reserves if you can access them under stress. If your dollars or euros can be turned off with the flip of a legal switch, they're not protection. They're a permission slip. Gold in a domestic vault is not permission-based. It's possession-based. And from that moment, the strategy stops being reactive and becomes structural. Russia produces significant gold domestically and can route that production internally. A country digs gold out of its own ground. The state buys it in its own currency. The gold never has to touch Western custody or settlement networks you can disrupt. It stays inside the border, a closed loop. Sanctions can even tighten this loop because the metal still exists, but the pipes reroute. Now zoom back to the number that triggered this entire discussion. Russia's gold value jumped by about $130 billion year over year, even while tonnage slipped. That means appreciation outpaced liquidation. That's the mechanism. And it points to the bigger story. Gold is repricing the system, not just Russia. So who else is running the same play? China, with strategic opacity. Disclosures that arrive in bursts, not a clean monthly ticker you can trade against. Opacity is a feature. If the world can track your schedule, they can tax your strategy. China also produces large amounts of gold domestically and has channels to absorb supply before it hits global markets. India, with a different motive but the same destination. When a central bank buys gold, it's not making a fashion statement. It's saying, we want settlement assets outside your switchboard. And the Gulf, building optionality. Optionality is the polite word for, we don't want to be trapped. If you have a commodity the world needs, you eventually ask a dangerous question. Why do I have to accept your currency to sell my resource? For 70 years, the answer was, because the system is built that way. But systems are built by humans, and what humans build, humans can rebuild. This is where BRICS matters, not as a slogan, but as plumbing. Payment rails, clearing networks, reserve recycling. If those pipes get bypassed, dollar demand falls at the margins, and reserve currencies don't usually die with a single crash. They bleed out as mandatory becomes optional. Here's the twist most people miss. This shift doesn't require a new world currency to replace the dollar tomorrow. It only requires a parallel lane, a lane where two large trading partners can settle without touching the dollar at all. Think about that for a second. If a buyer and a seller can exchange value directly, the middleman loses rent. The dollar's rent is global demand. The moment even a slice of commodity trade stops needing dollars, the system starts losing its automatic bid. And commodity trade is not small. Energy, metals, food. These are the blood supply of the real economy. So when you hear talk about BRICS experimenting with a trade unit or a settlement token, don't get distracted by the tech buzzwords. Blockchain, rails, platforms, those are details. The strategic point is simple. Build a mechanism that can clear transactions without SWIFT, without Western correspondent banks, and without dollar reserves sitting in New York. Now, does that mechanism have to be 100% gold-backed to matter? No. It just has to be trusted enough to be used. But gold changes the game because gold is the credibility layer. Gold is what makes two parties who don't fully trust each other still willing to settle. Because neither party has to trust the other's politics. They only have to trust the metal. And that's why gold keeps showing up in these proposals. Not as nostalgia, as collateral. The West built a system where trust is enforced by institutions. The alternative being built tries to anchor trust in an asset. That's a philosophical shift. And philosophical shifts become financial shifts. Now look at what has already been happening under the surface. For decades, the dollar dominated official reserves. But that share has been drifting down, not by accident, but by diversification. And at the same time, central bank gold buying has been hitting multi-year records. That combination matters, because it signals a reallocation of safety, from paper claims on a system to neutral collateral outside the system. This is why Russia's one-year valuation jump is so loud. It's not just a profit, it's proof that the reallocation works. And if it works, it spreads. Here's the part that should keep you glued to the screen. Once a country begins settling even a fraction of trade outside the dollar, it needs fewer dollar reserves. Needing fewer reserves means selling some treasuries. Selling treasuries means pushing yields up at the margin. Pushing yields up forces a response. Either the market absorbs it, or the central bank does. And if the central bank absorbs it, that is monetization dressed up as stability. So the loop is vicious. Diversification reduces demand. Reduced demand raises funding stress. Funding stress increases the temptation to print. Printing accelerates diversification. That is the feedback loop. And gold is the beneficiary of the loop because gold is what people reach for when the loop starts spinning faster. Now let's talk about timing, because timing is where narratives become traps. These shifts don't move like a straight line. They move in phases. Phase 1 is accumulation, quiet buying, building stockpiles, testing domestic vaulting, setting up alternative payment routes. Phase 1 looks boring on purpose, because if you announce your strategy loudly, you invite countermeasures. Phase 2 is coordination. More agreements, more bilateral deals, more pilot projects that sound harmless until you add them up. Phase 3 is implementation. A few large trades settle in a new way, then a few more. Then someone who is on the fence realizes the system works and joins to avoid being left out. Phase 4 is normalization. At that point, the new lane isn't news, it's infrastructure. And infrastructure doesn't ask for permission, it just gets used. So when people say, this will take decades, sometimes they're right. And sometimes they're confusing the build phase with the adoption phase. Building takes time. Adoption can be sudden, because adoption is driven by incentives. The moment a new lane is cheaper, safer, or politically cleaner, adoption can spike. That's why Saturday spreadsheet updates matter. They're not drama. They're indicators that the foundation is being poured. Now here's another cliffhanger. What happens if gold keeps rising while these blocks are still accumulating? It creates a self-reinforcing advantage. At higher prices, their existing gold stockpile is worth more. A bigger stockpile value makes their settlement mechanism more credible. More credibility attracts more users. More users increase demand for the credibility layer, and that layer is gold. Do you see how this becomes a spiral? It's the mirror image of fiat dilution. Fiat dilution expands units and weakens trust. Gold repricing concentrates trust and raises value. That's why 1 year can change the tone of an entire decade. Now here's the piece most people misunderstand. They hear gold-backed settlement and imagine a world where every coffee is paid in coins. That's not the claim. The reserve asset doesn't need to back every retail purchase. It needs to anchor trust between large entities, central banks, sovereigns, commodity trades, settlement balances. If you can settle big flows without touching the dollar, you don't need to overthrow the dollar in a day. You just need to reduce its role until it becomes replaceable. And replaceable is lethal for a currency that lived on default usage. This is why the $1.7 trillion idea keeps showing up. Strip the hype, keep the logic. If a block wants more gold weight in its reserve system, the price adjusts. Gold doesn't need new supply to rise. It needs new monetary demand. And monetary demand is not price sensitive the way jewelry demand is. So when multiple central banks do this together, they can lift the valuation of their existing holdings without adding a single bar. That's why Russia's year looks explosive, even with slightly lower tonnage. And this is the trap for anyone who thinks old, overbought signals will save them. Those signals assume a stable regime. We are in a regime where trust is being repriced. Now what can the Fed do about it? This is where the story turns from market analysis into physics. The Fed has 2 levers people obsess over. Rates, balance sheet. Raise rates to defend the dollar. Print to stabilize markets. But both levers are paper levers. They work inside a paper system. Gold is outside that system. Raising rates can attract capital for a while, but it doesn't answer sanction risk, debt math, or credibility loss. Printing is worse, because printing is the confession. It says, we need more units to hold the structure up. It may prevent a crash. It also accelerates the trust leak. You cannot print your way into credibility. So the Fed ends up boxed. Tighten too much, something breaks domestically. Loosen too much, the currency weakens externally. Gold becomes the scoreboard outside the box. Now let's pull this into real life, because that's where the story stops being abstract. Most people aren't thinking about settlement rails. They're living in dollars. They save in dollars. They borrow in dollars. They price their entire life in dollars. So what happens if global dollar demand erodes steadily, then faster? Foreign central banks hold fewer treasuries because they don't need the inventory. If fewer buyers show up at auctions, yields rise. If yields rise enough, the cost of funding the deficit rises. If funding costs rise, politicians face a choice: cut, tax, or monetize. Modern politics has a bias. It chooses monetization. So the central bank becomes the buyer of last resort. That's the path that turns the bond market into a managed market. And managed markets are functional until the currency pays the bill. That's when purchasing power becomes the sacrifice. You feel it as prices that reset higher and don't fully come back. Groceries, rent, insurance, energy. Wages negotiate slowly. Currency dilution happens fast. Reserve status isn't a prestige trophy. It's a subsidy. It lowers your cost of funding. It lets you import real goods for paper claims. When that privilege fades, living standards feel it before the news admits it. So when you see Russia's gold line jump by $130 billion in a year, don't read it as Russia got lucky. Read it as the measuring stick changed. Gold didn't magically improve. Fiat credibility got marked down. Now the skeptics will say, BRICS is messy. They can't run a reserve system. Reserve status has never required perfection. It required power, scale, and trust relative to the alternatives. Next, there isn't enough gold. Gold is not a fixed value token. If more monetary demand targets gold, The price rises until the stock above ground represents the value the system needs it to represent. And the US could do its own gold backing. Maybe, but the dollar system is gigantic. Without a major revaluation, any backing becomes symbolic. Markets price reality, not slogans. So we return to the core reality. Gold is being accumulated because it is neutral, and neutrality is priceless when the world fractures into blocks. Now I want to ask you two questions, and I want real answers in the comments. If sovereigns are reducing reliance on paper reserves, why would your personal savings plan assume the old regime lasts forever? And if central banks treat gold like insurance, why do everyday investors keep treating it like a punchline? That disconnect is where people get crushed. They wait for permission from headlines. Headlines arrive after positioning is done. By the time the story is obvious, the price is already charging you for being late. Russia didn't need to do anything dramatic for its gold reserves to explode higher. It just needed to be holding the right asset while the world repriced the wrong one. That's why this is not a Russia story. It's a monetary regime story. January 2026 wasn't just a month on a calendar. It was a data point that showed the Fed's limits. Not because the Fed is weak, because the Fed operates inside paper. And the world is moving part of its trust outside that paper. You can't issue confidence. You can only earn it. So what happens next? Watch the boring places. Reserve composition reports, gold purchase disclosures, trade deals that mention local currency or alternative settlement. Those are the early tremors. And watch the one thing nobody can fake, the price of neutral collateral when the world wants more of it. Because gold is not screaming, it's signaling. And Russia's $326.5 billion line was one of the loudest quiet signals you will ever see. And if you think this is just theory, remember, the biggest shifts always look impossible right before they look obvious. The market won't send you an invitation, it will send you a price. When that price moves, it's already too late to debate. If you want the next breakdown when new numbers hit and the narrative shifts again, subscribe. The headlines arrive late, the data moves first, and when the system finally admits what the spreadsheet already showed, you'll want to be positioned before the crowd even understands the question.